If you've spent any time looking at indexed universal life insurance, you've probably heard people mention that there are several moving parts to the product. Today, we're going to discuss and demystify, hopefully, all of those moving parts. In general, there are three components of these supposed moving parts, and they are broadly categorized as the cap rate, the participation rate, and the spread. Now, it's worth noting that for some of these moving parts, they may not move at all. In fact, as an example, if you have a participation rate that is locked at 100% from policy inception, it's never going to change. You don't have to worry much about it, and you won't hear your agent say much about it. So don't assume that by virtue of something not being brought up, it is being concealed or something is awry here. It may just be the case that it doesn't move, so there's really no reason to think much about it. The best way to understand these three components is to dive into some examples. That's exactly what we're going to do right now. I'm going to start by discussing the cap rate, which is probably the most common moving part that gets discussed with indexed universal life insurance. So to do a little bit of recap on functionality here, indexed universal life insurance is following an index, and usually that index is the S&P 500, and I want to be clear, value index. There are several other indices that may come up with different products, but in general, if it's indexed universal life insurance, you can almost rest assured that every single one of them are going to have an S&P 500, what we call 1 year point-to-point index. And what that means is it follows the movement in the index over a 12-month period. It doesn't necessarily have to be January 1st to December 31st. It may be a different time period because it's going to start when you actually start the policy, and it's going to move 12 months from there. So it could be something like April through March of the following year, and that would be your 12-month 1 year point-to-point movement in the S&P 500 value index. So what the cap rate does is set a limit on the amount of interest that can be paid per the movement in the index. So let's use an example where the 1 year movement in the S&P 500 value index happens to be 6%. Let's say that the cap rate that is effective for the policy that you're looking at is 9.5%. Well, under that scenario, 6% is less than 9.5%. We don't have to worry about it. You're going to get 6% interest paid on the cash value inside the indexed universal life insurance policy. Let's say in the next year, however, the movement is 15%, so the index grows by 15%. Well, we have this 9.5% cap rate that comes into play here. What that means is the interest that will be payable on your cash surrender, not cash surrender value, on your cash value in the indexed universal life insurance policy is going to be 9.5% because that is the cap rate. This 15% does not apply because we exceeded the 9% rate. You're going to get 9.5% rate. You're going to get 9.5% interest paid on the cash value in the policy. Now, there are some people who assume that while you're getting 9.5%, but there is a 15% movement in the index, the insurance company is keeping the remainder. That is not the case. The reason, or the explanation for why that's not the case goes beyond the basic sort of explanation of these moving parts today. So we'll leave that for another day. But just understand that this is how the cap rate works. You get interest payable based on the movement in an index up to whatever the cap rate is, and nothing more than that. Next, I want to address the participation rate. You may hear this referred to in shorthand as the par rate on indexed insurance or indexed life insurance, indexed annuity products. So this is a percentage adjustment to the payable interest based on the movement in the index. For a lot of indexed universal life insurance policies, the participation rate is 100%. It's fixed at 100%, it never changes, and therefore it is basically a non-consideration. We don't think much about it because it doesn't have any impact on the payable interest on the Indexed Universal Life Insurance policy. The math here is simply if the index is up, let's say 8%, let's assume that the cap rate is 9.5% from our previous example, and the participation rate is 100%. That means you're going to get 8% paid as interest on your cash value. But let's look at an example where the participation rate is now 150%. In that scenario, if the index is up 10%, the payable interest to your cash value is 15%, ignoring any potential cap rates that may be in play. If, on the other hand, the participation rate is 50% and the index is up 10%, that means that the interest payable to you is 5%. There are several Indexed Universal Life Insurance policies out there that have participation rates that vary because they have no cap rate. So we get rid of the cap, but there's a participation rate that is at play. That may be something like we follow the S&P 500 value index with no cap, but we have a 50% participation rate. So again, whatever the movement in the S&P 500 value index is, basically divided by 2, becomes the interest payable to you, as an example. So this is when participation rates this is how participation rates work, and they can adjust the interest payable to you if they are set at some value either above or below 100%. A lot of Indexed Universal Life Insurance products out there have a 100% participation rate, so they really don't come into play, but that is the idea or the spirit behind a participation rate. Lastly, we're going to talk about what we call a spread. And a spread can be thought of as an adjustment. And the adjustment is generally just a simple addition or subtraction, and almost all of the time it is subtraction, from whatever the movement is in the underlying index that we're following. So, for example, let's say that we have a 2% spread on our Indexed Universal Life Insurance policy, and in the given year, the index has increased by 10%. In that scenario, we take 10 minus 2, 8% becomes the interest rate payable to you. It is virtually unheard of for a spread to have a positive impact on a Indexed Universal Life Insurance policy. So as I mentioned earlier, it is almost always the case. In fact, is the case in every situation that I'm aware of. This will be a negative adjustment to the payable interest. So there may be caps at play, there may not be caps at play. So cap rates are basically a hard limit that restricts interest payable even when the index that we're following falls for the year or whatever time period we're following higher than the actual cap rates. The most common adjustment you'll find on Indexed Universal Life Insurance. Participation rates are a percentage calculation against whatever the movement in the index is, and in general, most Indexed Universal Life Insurance policies don't talk much about this because they're 100%, they don't change, so we don't see it come up often, but in the case of uncapped index features, we do often see participation rates of either less or higher than 100%, and they do impact the payable interest based on the movement in the index. Spreads are another way that insurance companies approach this. Usually, as I said, almost always a negative adjustment on the movement in the index. So again, oftentimes when we don't have a cap rate at play, we may see a spread now used to make an adjustment and become effectively a cap rate on the index option. Those are the moving parts. Now there's something else to understand about these. They can, in some cases, change. So cap rates may go down, they may go up. Spreads may increase and make that negative adjustment even larger, and participation rates can go up and down. So we may see at one point an Indexed Universal Life Insurance policy has an index option with no cap and a 150% participation rate. But we may then hear news a few years after buying the policy that our participation rate is going to go down to 140%. This means that the adjustment is going to be a little less favorable than it used to be. We may also see a scenario where the participation rate goes up to 165%. So now the adjustment is better than it was when we first bought it. This is also why we sometimes hear about moving parts, because these things are not set in stone. And while some people may suggest this is one of the negative aspects of indexed universal life insurance, I would call to your attention the fact that there are several things related to regular universal life insurance, whole life insurance, where we are not set in stone. There are variables that the insurance company can adjust to make things more or less favorable to the policyholder. Though this seems like a very complicated subject, that's it. That's everything you need to know about moving parts. See you next time.